Hi there, and welcome to another in our series of special revision webinars looking at key aspects of economics ahead of the A-level exams. In this webinar, we're going to take a few minutes to focus on some ideas from Keynesian economics. And what I'm going to try to do in this session is to think about some key Keynesian concepts, but more importantly, make a link with the relevance of Keynes to modern day issues, policy problems, the current context. So hopefully you can apply some Keynesian ideas in your essays. It's always a good idea to bring into your longer essays perspectives from different schools of thought. And clearly Keynes, 81 years on from the publication of the General Theory of Interest, Employment and Money, remains in many ways preeminent amongst economic thinkers of the last 100 years or so. What I'll try to do in this session is take you through perhaps 5 or 6 of these key ideas: the importance of psychology and animal spirits, effective demand, paradox of thrift, liquidity trap, the multiplier, the critique of fiscal austerity, and Keynes's views on global imbalances. Of course, whenever you're ready, you can press the pause button in the video so you can take a note or two, or take a few moments to think about what we're looking at. So an understanding of Keynesian ideas, I think, is really helpful in understanding the wider issues of macroeconomic stability in terms of inflation, in terms of unemployment, real incomes. Keynes, at heart, was an intellectual, a deep intellectual, a great thinker, educated at Eton and latterly at Cambridge University. He then went back to teach as a fellow there, died prematurely at the age of 63, just a year after the end of the Second World War. Fundamental to Keynes's belief was the idea that the free functioning markets that you learn about in economics are oftentimes quite volatile. Think about commodity markets, for example, or financial markets, and crucially, not always self-correcting in the aftermath of an unexpected economic shock. And so Keynes argued that the free market system, the capitalist system, remains prone, of course, to lengthy periods of recession, or even worse, depression. Depression, I suppose, will be a sort of at least a 10% fall in GDP from peak to trough. A key idea from Keynesian economics is that an economy can get stuck in an underemployment equilibrium. In other words, a level of output that is not consistent with achieving an economy, a labour market that's close to full employment. He argued that in a world of stagnation or depression, where private sector demand in particular is low, direct state intervention might be essential to restore animal spirits, to restore confidence, and to lift aggregate demand. And crucially, when we think back, particularly if you've been studying behavioural economics, of course, challenges many of the axioms of neoclassical thinking. But Keynes actually, this is 80 years ago now, was one of the first economists to criticise the economics profession for their commitment, adhering to unrealistic assumptions. I think Keynes understood, for example, the importance of psychology in macroeconomics, and that, of course, has come back to great prominence in recent times. This chart, I think, is really important context for us. It shows the level of GDP in the UK in recovery phase, in sort of post-recession recovery since the Second World War. So we've had a number of recessions, 56, 57, 61, etc., through to 2008, of course. And notice that 2008, it took nearly 6 years for GDP to recover to the pre-crisis level. The depth of the recession was deeper than anything we've seen in the post-war period, and the duration of the recession and the slowness of the recovery was also the longest in the post-war period, akin to the 1930s. And I think Keynesian economics helps us understand a little bit about how that might have been avoided, perhaps, with a slightly different policy mix. Robert Skidelsky is perhaps the preeminent scholar on Keynes, Lord Robert Skidelsky. There are others, but Skidelsky is right up there. Here's a great quote: Keynes made a distinction between risk and uncertainty. So risk is when probabilities can be known and measured. Uncertainty exists when they can't be known or measured, and when the future is essentially unknowable. Where will we all be in 5 or 10 or 15 years' time? So Keynes placed a lot of emphasis in his work, in his analysis, on the economics of uncertainty. And in a world of uncertainty, sentiment truly does matter. So this leads us on to the idea of animal spirits. Now, animal spirits is basically a mix of the state of play of confidence, of people's trust, of mood, expectations amongst agents, be they producers or consumers. And Keynes argued that animal spirits can move around quite violently, very quickly, as people change their thinking, sort of herd mentality can kick in. Crucially, in a recession or a slowdown, when confidence is low, people tend to save more, and so too do businesses. And businesses, because demand is weak and profits are perhaps coming in less than expected, they rein back on production. Perhaps they postpone or they cancel some big investment projects. So in other words, when people save more and businesses save more, consumption falls, investment falls, the real economy can contract. Higher saving and reduced investment can both have the effect of lowering aggregate demand, shifting AD inwards, cutting incomes and causing a contraction in the economy. So animal spirits are really key to understanding the economics of Keynes. Here's a chart showing consumer confidence. That's the net balance of optimists against pessimists. Typically people are quite pessimistic, but look at the collapse in confidence in 2008 and 2009 for several years. Hence, consumer confidence was at a pretty low ebb. And these confidence surveys can often indicate changes to the economic outlook as well as kind of turning points in the cycle. So the last couple of years, confidence has recovered somewhat, dipped a bit in 2016, perhaps following the Brexit vote, but a return to sort of normality in terms of confidence. Keynes, I'm sure, would have approved of that. So there's lots of sort of Keynesian ideas that I think have a modern day relevance, a modern day resonance, if you like. So animal spirits is really important. People's confidence and expectations affects people's behaviour, for example, in a world of deflation, where people expect prices to fall. They may choose to postpone their spending and save more. Businesses looking ahead, they think about the expected return on their investments. And if animal spirits are low, planned investment tends to fall. Some people look ahead to the future and think, well, how much tax are we going to have to pay? With a triple lock on pensions and with rising population and ageing population, perhaps we'll have to pay higher taxes in the future, and that might affect their long-term animal spirits. Another important Keynesian concept was that of effective demand. That's demand backed up, not just a willingness to buy goods and services, but an ability to buy goods and services. And so effective demand is a key Keynesian idea I'm sure you can bring into your essays and your answers at school. Modern day relevance, so targeted tax cuts, giving tax cuts perhaps to lower income households who have a higher propensity to consume. Supply side policies designed to make housing more affordable, bring down the cost of renting, for example, which in turn would effectively increase people's spending power. If they're spending less on rent, they can spend more on other things. The minimum wage, of course, is a direct way of changing the effective demand of people on low incomes, although there's a debate about whether employment might suffer as a result. A really important idea in Keynesian economics, one that I think lots of students write about, and rightly so, is the paradox of thrift. This is the idea that it's rational at a micro level to save more for the future, but if we all save more together, and we save a lot more, actually we can impoverish ourselves as a result. Companies buying back their own shares to lift the share price, or hoarding cash instead of investing, is a modern day example of the paradox of thrift, and of course people hoarding cash in a world of deflation. It's okay, by the way, in an exam to draw flow diagrams. If you wanted to explain something neatly in a flow diagram, it's absolutely fine. It doesn't have to be a continuous prose paragraph. Lovely quote from Keynes here: in a world of uncertainty, the tendency to save is often stronger than the incentive to invest. That's a lovely phrase for our times in many ways. And whilst it's rational to save more, which increases the savings ratio, that actually then causes a fall in consumption of goods and services. In other words, an inward shift in aggregate demand. That can risk a deeper recession, and then in theory that can cause a fall in real incomes per capita, which actually leaves people with less money to save. And this is the paradox of thrift. It's rational to save more at a micro level, but that can lead to some perverse macroeconomic effects. Skidelsky argues that in terms of economic policy, Keynesian economics only has one proposition, and that's namely that governments should make sure that aggregate demand is sufficient to maintain a full employment level of activity. The purpose of the 1936 general theory was to explain how an economy could get stuck in a low employment trap. And I think that's quite important when you're writing about supply-side economics. You can have all the capacity in the world, you can be innovative and productive, and have lots of capital investment. But if you've got a strong supply side, equally you do need a strong demand side as well to make full effective use of that capacity. Here's a chart showing monetary policy since 1946, the base rate of interest. Of course, the Bank of England has only been independent for 20 of these years. But we can see now at the moment just how low interest rates are in the post-war context. Well, I wasn't around in 1946, but they must have seemed pretty low then. But now interest rates of 0.5% or less since 2009, they are historically low. And of course, Keynes had a theory for most things, and Keynes argued that at times, even if interest rates are low, aggregate demand and the economy generally doesn't necessarily respond significantly to a low interest rate environment. And he called this the Keynesian liquidity trap. And so here's another important concept that might be useful in your exams. A liquidity trap happens when low nominal interest rates, that's the interest rate not adjusted for inflation, and a high amount of cash balance, in other words the economy is not short of liquidity, both of those factors fail to stimulate the growth of aggregate demand. There are two sides to a liquidity trap. One is the risk-averse nature of commercial banks. So banks might be reluctant after a crisis, for example, when they've had their fingers burnt, to lend to businesses who want to grow. Even if they do lend, they may attach a risk premium. They'll say, well, we'll charge you the base rate of interest, let's say, plus 10%. And of course, post-crisis, many banks are required to hold more capital of their reserves, and that might limit their lending ability. That's one side of the trap. The other side is the borrowers in the market. So businesses and consumers might be low on confidence, low on animal spirits, and also they might be focused on cutting debt rather than taking out new loans. So all kinds of reasons for thinking that a liquidity trap can happen. And when that happens, monetary policy becomes ineffective. And Keynesians would then say, well, we need to move towards fiscal policy. One bit of theory, a neat bit of theory, is the idea of marginal efficiency of capital, or so-called investment demand. So the marginal efficiency of capital, MEC, is basically the expected return of a project, an investment project like a new building or some new machinery, over the cost. So you might work out, for example, that if you put £50,000 into a new shop, you might earn a return of, let's say, 4% on £50,000, £800, let's say. But that might not be enough, because if you put the money in a bank, there's an opportunity cost of investing that money, that £50,000. So you do have to compare the return on a physical, tangible investment with the likely return on interest on a bank account, for example. And we get the idea of marginal efficiency of capital, the expected rate of return of capital over cost compared to the rate of interest. Now, Keynes argued that lower interest rates, as expansionary monetary policy, can be effective in increasing planned investment, but that the relationship was relatively inelastic. The investment demand curve was relatively inelastic with respect to interest rates. And you can see this on the diagram here, quite a big fall in interest rates from R1 to R2 only leads to a small increase in planned investment. What mattered to Keynes much more was other factors other than interest rates. So, for example, technological change, the rate of growth of demand, the expected growth of demand in your market, and all of this was lumped into animal spirits, business confidence. In this diagram, we see, for example, an inward shift of the curve. Deterioration of sentiment causes an inward shift in the investment demand curve. So at any given rate of interest, R1, now we have less investment than we had before. And of course, that's what can happen in a recession. Interestingly, Keynes would have had views about quantitative easing. A Keynesian economist, again, Skidelsky, argues that quantitative easing, the central bank buying government debt, and the UK Bank of England now owns 30% of the stock of outstanding government debt. When a central bank buys government debt, that drives down the rate of interest on long-term bonds and mortgages. But from a Keynesian perspective, the key question is whether that actually leads to an increase in investment. Does it stimulate the real economy? Capital investment, production, jobs, incomes. Here's Skidelsky's quote: "Quantitative easing has had a positive effect on the stock market prices and also house prices as well, but most of it has not yet filtered into the real economy. It's bid up the prices of existing assets, but not stimulated new investment." And here's the killer quote: because lenders, aka the banks, are still asking more from borrowers than borrowers can expect to earn. And that's the fundamental problem, one of the reasons why QE doesn't necessarily work very effectively. So a typical Keynesian approach to managing demand is to argue the case for an active use of fiscal policy, particularly when the economy is in a downspin, and particularly when private sector demand is weak. So they would favour, for example, counter-cyclical policies. You spend more, run a bigger deficit when the economy is in slowdown or recession. Active measures to inject extra demand into the circular flow and hopefully lift the economy out of recession. They would favour targeted tax changes. So, for example, give more money in direct tax cuts to low-income families with a higher propensity to spend. They would favour labour-intensive investment projects, building new roads, new bridges, social housing, because they would argue the multiplier effect can be quite big for that. And they would argue that if you get the investment right from the state, if you can borrow, for example, for 10 years at 2% yield, and you can build X 100,000 new homes, or improve the road network, or make significant investments in sewers and water treatment and technology and telecoms, it shouldn't be beyond the wit of man or woman to find investment projects over a 10, 15, 20-year time horizon which generate a rate of return, including the social return, greater than the cost of borrowing. Keynesians would argue that well-targeted, timely fiscal expansions can actually pay for themselves, particularly if they create more tax revenues in the future. So this brings us on to the question of fiscal austerity. I'm not going to go through the entire slide here, but is the Conservative government right to use fiscal austerity? Their justifications are that the government needs to cut debt. In the long run, that's going to keep the tax burden down. A smaller state encourages the private sector to grow. Cutting the deficit brings down the annual cost of paying the interest on debt. It makes the economy more attractive to foreign investment. And actually, you should be cutting the deficit during a recovery. You should be mending the roof when the sun is shining. So you've got some fiscal buffer. You've got a bit of leeway on the deficit if the economy goes into another downspin. The Keynesian arguments against austerity are that austerity can be self-defeating, particularly if it tips the economy into deflation. The bond yields at the moment are very low. This is a time to invest more now rather than wait. That effective infrastructure investment actually increases both demand and long-run aggregate supply. And that in fiscal policy terms, if monetary policy is becoming less effective, it's wrong to cut government spending when the economy is in a liquidity trap. Ultimately, you need a country to grow, for per capita incomes and jobs to rise, to be able to pay back debt. And fiscal austerity, Keynesians will argue, makes that, for goodness sake, a lot worse, a lot harder to achieve. Here's a chart showing the risk of price deflation. Of course, deflation can happen both on the demand side, so Keynesians would tend to focus on the fall in AD, the output gap becoming negative. Of course, deflation can also happen when the supply side improves, where there's technological advance, higher productivity, perhaps a high exchange rate causing the price of imports to fall. Keynes would be a critic of crowding out. Crowding out is the idea popular in the 70s and 80s and sort of returned a little bit recently, that if the state borrows more, that drives up the real interest rate. As you can see here, increased government borrowing, D to D2, may lead to higher demand for loanable funds. That causes interest rates on bonds to go up, which also makes it more expensive for companies to borrow money. So this is a critique of Keynesian economics. The counter arguments are that the probability of 100% crowding out of the private sector by the public sector is pretty much zero, especially if the economy is operating below capacity, and also if there's lots of saving to purchase the debt. Keynesian economists will argue that well-targeted investments can crowd in the deficit, in other words, cut the deficit over time. The Keynesian perspective, I think, is really quite important when we think about sort of how to respond to a recession, how to respond to a financial crisis. So in 2008, obviously we had the big short moment, the collapse of Lehman's, the world financial system on the brink, and Keynesians would have and did indeed support a strong monetary and fiscal stimulus, interest rates being cut, deficits going up, public sector spending replacing private sector when the private sector demand is collapsing all around us. Keynesians would favour fiscal infrastructure spending, particularly labour-intensive projects, some bailouts of the private sector to prevent catastrophic loss of jobs, The key to Keynesian economics is to prevent a recession turning into a depression, and that can happen, of course, if animal spirits disappear. The Austrian approach, of course, is very different, the free market approach. They dislike bailouts of banks, for example. They think that leads to moral hazard. Banks then take even higher risks if they know they're going to be bailed out. They would prefer those zombie businesses to collapse rather than continue to stagger on with low interest rates. They would say, instead of just bailing out the system and reflating demand, this is the moment to impose a lot of reform on markets, reform the supply side of the economy, introduce fresh competition in markets. And in particular, they're against periods of ultra-low interest rates. Keynes would argue it's just ineffective, the Austrian approach, that the low interest rates distorts the allocation of capital and can cause malinvestment in an economy. So the fiscal multiplier, I think, is really important if you want to understand Keynesian economics. You probably revise the multiplier effect, and so the fiscal multiplier is the effect of a £1 change in government spending or £1 change in tax revenues on GDP. Now, clearly, G and T are not going to change by £1. It could be £1 billion, but the point is made. The IMF did some research of this in 2014 and found that the government spending multiplier tends to be a little larger than the tax multipliers. So if you get a question on fiscal policy, the IMF reckon that the impact of an increase in government spending on the economy is bigger than a similar cut in tax. One of the reasons is very simple by Keynesian theory, that tax cut's less effective, because if you give people a tax cut, some people will save it anyway, and so that reduces the size of the multiplier. Whereas government spending tends to be a direct injection, adding to aggregate demand in the first and second and third rounds. The IMF also found that fiscal multipliers are generally bigger in an economic downturn than in an expansion. And I think that again supports the Keynesian view that in a downturn you have plenty of spare capacity, monetary policy probably ineffective, so kick-starting the economy with a well-targeted government spending stimulus can make a difference. Here are some of the key factors affecting the value of the multiplier. The multiplier values tend to be high when the economy has plenty of spare capacity, when the propensity to import and tax are fairly low, and crucially, when people who are the recipients of extra income tend to have a high propensity to consume. Multipliers tend to be lower when the economy is close to their capacity limits, when the propensity to import is high, and also crucially, when the economy is close to its capacity, you tend to get higher inflation, which then leads to higher interest rates, which then can dampen down the effect of a stimulus. If you want to put a number into your exams, contextual evidence, Blanchard et al. At the IMF calculated the long-run multiplier value for government infrastructure projects to be between 1.5 for advanced countries and 1.6 for developing countries. So not zero, it's positive, but obviously it's not a huge number. Here's a chart showing the link between the multiplier and the elasticity of supply. The multiplier effect tends to be bigger when aggregate supply in the economy is fairly elastic, compared to when it's inelastic. Crucial to Keynesian economics, I think, in the modern context, is the importance of infrastructure. Students can get some seriously good marks in exams if they pinpoint both the short-term and the medium-term and the long-term importance of infrastructure investment spending. There's some examples in the UK, including Crossrail, second Forth Road Bridge in Scotland, the London Gateway Port, the new super sewer, projected investments in nuclear power, etc. Crucial point about infrastructure, it has potentially big multiplier effects, but it's also triple powered. It adds to demand, it creates jobs, and potentially it increases a country's productive potential, productive capacity and export potential. Infrastructure spending, to my mind, is really important, particularly when we have a transport network and a telecoms network that's under pressure and a housing stock that's chronically underbuilt. So what determines the size of the multiplier? Well, crucially, and so Keynes would favour fiscal expansion, but of course we need to know what the multiplier is going to be. What determines the size? First of all, design. Do you go for government spending or tax? Well, we think the multiplier is higher for government spending. Secondly, the financial stress makes a difference. Where people are deeply uncertain about the future, people oftentimes save, for example, a tax cut because they think the future is not looking too good. Is your expansion temporary or permanent? So if you think the tax cut is going to be permanent, people might build that into expectations. If they think it's a tax cut ahead of an election, which will be quickly reversed, people tend to save it, etc. Crucially, we also need credit. So if fiscal policy works in injecting extra demand into the economy, we still need a banking system, a financial system that's able to provide the credit, the loans, the funding and the finance to businesses that want to grow. So unless they can access the funding and the credit, that is going to limit, it's going to constrain the ability of the economy to react to the multiplier. The other aspect is the openness of the economy. So if you have a very open economy, which has a high ratio of imports and exports to GDP, then typically you are going to suck in imports when you're building a new road or investing in the telecoms infrastructure. Closed economies, if there's a big if they can meet the investment demand with their own resources, will have a higher multiplier. Equally, if you have an open economy, you may be able to get those cables, those fibre optic cables, the bricks you need, the high technology products for the investment projects, you may be able to get them at a better price by importing from overseas and exploiting the law of comparative advantage. So what we've done in this session is we've kind of thought about some Keynesian economics here. I think it's important to think about how you can bring Keynesian economics into your wider debate. It is always a good idea in A-level to bring in perspectives from different parts of the subject. And hopefully, over the last 25 minutes or so, you've been able to see how the Keynesian view is one way in which you can bring those into your wider essays. Hopefully that'll be a good way to do it. Keep in mind that these webinars are all on YouTube, so check them out, and there'll be lots more webinars ahead of the A-levels. Take care, see you soon.